Hey, everybody, and welcome back to the Teaching Tax Flow Podcast, episode 168. We're diving directly into something that you may not want to admit is a problem with your tax life. What we're getting at here is we're going to look at those commonly missed deductions. So kind of that famous line, right, is you don't know what you don't know. Well, after this one, hopefully you have no excuse for this. Chris Picuro, my co-host here, as always. Chris, I'm excited to dive into these because I think a lot of them we may even know about and just kind of forget about year over year, right?
Well, now, because you listened to this podcast, maybe you listened to it the day it came out, right before the new year. You might have been toasting on New Year's Eve with your friends and bragging about your knowledge on tax planning and strategy and saying, guess what? Happy New Year. I'm tipping my glass of champagne. Maybe it's grape juice, who knows? We used to have, when I was a kid, New Year's was a big deal with family. So we would have grape juice for the kids and the people that don't like to partake in champagne. And now when you have that at your party, John, you can brag to your friends and say, I have educated myself about the missed deductions, and when I have the tax return prepared for my 2025 return, or if I self-prepare it, I'm not going to miss these. So yeah, so we're giving back to the community. In all seriousness, if you're listening, watching, Happy New Year. If you're watching on YouTube, we want to know what's I don't like resolutions, John. My own personal opinion. What are your goals? What's one thing tax or finance related you want to accomplish in 2026? And we'd love to hear from you. We've had a lot of great interaction in our private Facebook group, Defeating Taxes. And a lot of times, some of these topics that we talk about here on the podcast come from that group. So let's jump into missed deduction. Anyone having FOMO?
And I know that even just the topics that we choose for these podcasts, right? I know we have a lot of listeners. We know everybody listens to every single one of these, right? We've been doing this for a while. So every week, and obviously 168. So you can do the math. We've been doing this for a bit. So I think we've kind of figured this out. And I know we always struggle with, which topic are we going to do for the very last one of the year, right? Because people are busy, they're running around. And this one I think is very fitting because it's not like you have to take with everything. You don't have to take a lot of action like the second you listen to this. You just kind of have to know they exist for the most part. And I'm looking over my camera at a quote that's on my board that's always in sightline for me. It says, I can't read who it's from, but it says procrastination makes easy things hard and hard things harder. So
Good
if
point.
somebody's procrastinating on understanding what some of these are, learn it now, not the day before a tax deadline, right?
Exactly. It causes
And that's why we're here.
Stress is expensive. And I want to say thank you to everyone in the Defeating Taxes private Facebook group. We recently had a poll. I think we're keeping it up there a little bit. What topics do you want to hear about? We've had some people in the community add their own topics. We're seeing your votes, and we're gonna address those topics as well. So let's talk about commonly missed deductions. Let's start with individuals, John. The first thing now with OB3, right? One Big Beautiful Bill Act, we know that the SALT tax deduction, state and local income tax, that deduction maximum increased significantly. There are some income phase outs. And we typically think of people that are in those higher tax states. The states on Santa's bad tax list: California, New York, New Jersey, Illinois, Wisconsin, Minnesota, et cetera, et cetera. Oh, yeah, Massachusetts. Don't worry, we see you. Georgia, you're sneaky too. But the non-tax states, meaning we don't have state income tax, Tennessee, the Floridas, the Texas, well, you could still deduct some state income tax. And this is commonly missed: state sales tax deduction. So if you if you have if you purchase a new vehicle, a boat, or something big that you paid a state sales tax on, that's deductible on Schedule A if you itemize. You can also take a standard or simplified state sales tax deduction based on your income and what county you live in as well. So don't miss the state sales tax deduction if you itemize, even if you're in a what we call a non-tax state. If you itemize and you deduct medical expenses, we know that medical expenses have to exceed 7.5% of your income to be deductible. It's an itemized deduction. we have another podcast episode on how savings accounts and strategies to make these medical expenses deductible. But remember, medical miles driven are deductible for 2025. That's 21 cents per mile. So, John, like for instance, let's say you have to go to physical therapy for a few months, or let's say you live in a more rural area and you drive a bit to get to your doctor. That's very common. Or you have to see a specialist. You could definitely, like, we have clients that drive quite a bit to see the doctor. You could have a taxpayer that lives maybe 2 hours away from a specialist, and they're driving a significant amount of miles to get there. Definitely take that 21 cent per mile deduction.
Yeah. And quick question too, and yes, that I'm so glad you brought that one back up because I was really surprised in that one, even when we did the podcast on that topic. And that's really, and then I have another question back to the salt tax really quick. I'll get to that. So with the mileage deduction for medical purposes, I think is the way to put it, that's really the only opportunity to deduct mileage if it's not a exclusive use or a vehicle for business purposes, right? I can't think of any other
Right. Well,
mileage
there's going to be
deduction for
another
personal.
missed deduction on individuals.
Ooh,
Charitable
okay, we'll get to
miles.
that one.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell them TTF sent you.
So
Yeah,
here's a quick
14
one on
cents.
the salt tax.
Oh, on the
I don't
salt
know.
tax.
Yeah, sorry. Yeah, let me go back to this one because I was just thinking of this, and I don't know if we discussed this on that podcast. So I'm sure some people are listening to this and they're like, "Oh, state and local, I pay tax on everything. Fuel, I go to Best Buy and buy something." Is it only for specific items that you're paying state and local, or if somebody really wants to get down to the nitty-gritty and save receipts for every single purchase throughout a year, they could
You
tally
could.
those up?
Yeah,
Okay.
so say you can tally up your sales tax you paid, or you could take that, a simplified number, or
Okay.
standard number. But yeah, or you could take the simplified or standard number, plus if you had a major purchase like a vehicle, you could take that sales tax, a boat, that sort of
Okay.
stuff. That's why it's a missed deduction. It's commonly
Yeah.
forgot.
So if
Um,
somebody likes buying everything and anything on Amazon and they spend a crap ton every year, get out your calculator.
sure,
So,
you could run a report.
yeah.
So
Awesome.
medical
Thank you for
miles.
clarifying that.
Let's talk about charitable miles. Charitable miles are another deduction. So a lot of people donate their time, maybe at a church or a nonprofit, animal shelter. Maybe they went to Habitat for Humanity. Well, the miles to and from that volunteer work or charitable work, you get a deduction for 14 cents per mile. That can add up significantly.
I never knew that either,
Hmm.
actually. Okay.
And then student loan interest is deductible. Sometimes people miss that because
Mhm.
they're thinking, "Hey, I'm not in school anymore." And then gambling losses. Remember, gambling losses, there's a major change in 2026. We're going to address that in another podcast episode next year. But for 25, you could deduct your gambling losses on your personal return up to your gambling wins as an itemized deduction on the federal return. Now, most states don't honor that itemized deduction, but again, that you can deduct losses up to your wins in 2025 if you itemize your deductions.
And for anybody that's listening to this, that's like, "Oh my gosh, I must be the only person that doesn't know about this." I believe that was one of the most popular reels we've put on YouTube, or when we did something happen there where it just took off,
Yeah, so we'll probably
because
do
it's
that near
surprising.
the Super Bowl time. We'll probably do that near the Super Bowl time. Here, we'll do a special
Right.
gambling loss deduction. There's a whole new set of rules for 2026 for that.
Absolutely.
Absolutely.
And I'm sure a lot of people have more losses on that specifically because it's easier to gamble now. I mean, all the online
Sure.
opportunities
I
and all
mean,
that, so
last time I checked, casinos and online sports wagering companies aren't nonprofits, right? So sure they're doing all right. Let's talk
absolutely.
about commonly missed deductions for business owners. So this could be a Schedule C taxpayer, self-employed, single member LLC. Um, or disregarded entity, or maybe even an S corp owner, maybe even a C corp owner. Home office deduction, huge miss. I see it all the time where people have a legitimate home office, so it has to be your primary place of business. And let's assume you have a legitimate home office. Definitely take that home office deduction. Now, if you're an S corp or C corp, how you take that deduction changes versus being self-employed or a partner. If you have a question on home office, drop a comment here. If you're watching on YouTube, if you're listening, walking your dog, going for a walk, a jog, and you're listening to the podcast or the video, the audio, jump into the Defeating Taxes private Facebook group. You can even go to defeatingtaxes.com. You could post anonymously. Ask your home office deduction question. We are happy to help. That is probably the most commonly missed deduction.
And with that one, Chris, I'd almost put the challenge out there for anybody that, again, on YouTube's kind of the platform where we post this a lot. We still get emails, we still get messages. Maybe people aren't comfortable sharing some stuff, but we almost put the challenge out there. Comment on this video and watch the dialogue grow, right?
Uh,
So, I mean, down to anything. Let us know anything you, the listener, have experience with a home office deduction. If you have a question on how much or if something, obviously every situation is different, but I would love to know exactly even how many people have taken that deduction. Even if they don't have a question, just, put a comment in there, say, I have since 2002 or something. Just let us know. I'm kind of curious. So maybe we'll
Right.
do like a more formal poll, but I would love to see, our YouTube channel kind of blow up with some comments on that.
So let's talk about startup costs. Those are deductible. The first $5,000 of startup costs are deductible immediately. You can make an election. The remaining amount we amortize or write off over 15 years. Business miles, mosh, the standard mileage deduction is very generous. So you don't have to deduct the cost of your vehicle. You could just take the standard mileage deduction, which for 25 is over 70 cents a mile. That's very generous. So a lot of times people have business miles that they forget to deduct. They're just not thinking about it in the course of running their business. Let's stick to a couple more on health, on business owners. Health insurance for self-employed people. Remember, I just mentioned that typically medical expenses are only deductible if they exceed 7.5% of your income. However, if you have health insurance premiums that you're paying and you have self-employment income, that is deductible. Now, it's not deductible against your Schedule C income, but it's still deductible, what we call above the line for adjusted gross income. I can't tell you how many times I see that missed, or the person prepared their return or someone prepared their return and put this health insurance premiums as just a regular medical expense, and you don't get the preferential treatment. Retirement plan contributions. This one's often missed or forgotten about. Remember, if you're self-employed, you have until you file your tax return to make a SEP or solo K contribution. So that's why a lot of times we intentionally extend your tax return and give you more time to contribute for the previous year. So remember, not all deductions have to be paid before December 31st, or all expenses have to be paid before December 31st to get a deduction for it. So if you're self-employed and you still want to contribute to retirement, talk to your tax professional and make sure that you are planning that retirement contribution and understand the timing of it.
And here's a moment of transparency. Maybe I shouldn't say this. I mean, let's preface this, right? Like, I am not the tax guy Chris is, right? I honestly forgot about that.
Mhm.
That one being an example for the deadline is when you file, not December 31st.
Right.
So sorry about that. But so yeah, again, anybody that's listening to this, you're not the only one that may not know that. That I learned through osmosis, and I hang out with this guy almost every day, a friend and colleague, right? And I forgot. So
So finally, let's talk about rental property owners. What's commonly missed? Travel to and from your rental property. You could have the mileage deduction. Let's say you're performing services, you're meeting tenants, you're doing handy person work, you're whatever it is, that's going to be deductible. Depreciation. This is so commonly missed, but it's confusing, right? Because a lot of times someone says, "Well, my property's appreciating. I don't want to take the depreciation deduction." Guess what? You have to. The depreciation deduction is very commonly missed. Um, when I look at people that either self-prepared a return or used another tax professional. If you miss the depreciation deduction, take a deep breath, talk to your tax professional because it's not easy to fix, but it's very fixable. And using what's called a Form 3115 and a 481A adjustment, basically you've got to change your accounting method and make that correction. But don't miss the depreciation deduction on your rental properties. And a cousin of that is don't miss a step up in basis on rental property. So if you inherit a rental property, or if a spouse inherits a rental property, remember you have to step up the basis. We could talk about that a little bit with is missed deductions for individuals. So if you inherit something, make sure you catch the step up in basis. And I think we have a whole podcast episode on that. So focus on it. Remember, if you're listening or watching, if you've inherited an asset, talk to your tax professional and make sure you stepped up the basis on that asset, meaning you got to change your cost basis in that asset up to the fair market value the day you inherit it instead of the amount it was purchased for. Why? Because that's going to reduce the amount of capital gain tax you pay significantly. So a couple more on rental properties while as we wrap up. Make sure you don't forget about your passive activity losses. We talk about not every tax benefit has to be this year, but I can't tell you how many times we have a taxpayer that has losses from a rental property that are carrying forward on their tax return. So that it was maybe their income was too high to take that deduction in the current year. So it carries forward as a PAL, passive activity loss carry forward. That is reported on a Form 8582. Review, if you have rental property, review that. Because a lot of times, if you change tax software, change a tax preparer, you'll miss it. You will miss those past activity loss carry forwards, and that could be a very valuable deduction in the future. And the final one on rental properties is going to be qualified business income deduction, QBI deduction. Remember, that's up to a 20% deduction. So this is for people opposite of the passive activity loss people, the people that have profit from the rental properties. If you might qualify on top of that for the qualified business income deduction, there's a safe harbor for that too. So if you either have losses from your rental property or you have a significant profit from your rental property, review your tax return. That's going to be on Schedule E, Form 8582. I know I got technical here, but talk to your tax professional about that. Don't miss out on those deductions because a lot of times missed deductions. I got one more bonus one as far as capital loss carry forward on individuals. But remember, those deductions, they might not change your tax return in the current year, but they could significantly change it in the future year. So it's so important to really look at those schedules and review the return. And John, this kind of inspired me. I think we should do more work next year. I think we
like it.
should have some more YouTube videos to expand on some of these deductions, not just talk about them. I might do some walkthroughs of where you're going to find them on your tax return.
Let's do it. Let's absolutely do it. And honestly, Chris, if I didn't have to disconnect my mic and cause all kinds of audio problems, I'd like mic drop it for you. If anybody knows what that means, it's super cool. I had to end the year with a corny joke, right? But really, I'm going to make this so easy for anybody that's listening to this. We're not going to give all the detail, but as far as for topic bullet point ideas, I'm going to put every one of these that we talked about in the show notes, copy and paste it, see which ones apply to you, and send them to your tax pro. Literally copy and paste. Say, oh, I have a question on this. I don't know if I got this. Make it easy. That way
Yeah.
you're done. So we'll
Well,
end on a fantastic note this year with
yes,
that. For you.
Happy New Year. We appreciate you for teaching tax law community. It's because of you. We do this. It's a labor of love for both of us. And I just wrote down, John, we're going to have some, I like doing a little bit more walkthrough of where these missed deductions might be. So
Let's do it. Let's do it. So Chris, you mentioned, everybody, you have a fantastic end of 25. And don't worry, you don't have to do everything before New Year's Eve. You got a little bit longer, which we'll talk about tax extensions again here in the very near future. Everybody, you have a great rest of the year. And, throwing out the window our normal clothes, but we will see you back here next year on the Teaching Tax Flow podcast. Have a great one, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.